Today, our mission is pretty clear. We're diving into the world of investment accounts, which, let's be honest, can feel confusing sometimes.
Absolutely. It's a landscape full of different options.
Exactly. So think of it like we're opening up a sophisticated toolbox. Each account isn't just a place to park money. It's a specific financial tool, designed for a particular job.
A financial hammer or saw, maybe?
Yeah, something like that. We got a whole stack of sources here, guides to all these different account types. And our goal today is really to cut through the jargon.
Pull out the important bits.
Right. Extract those key nuggets of knowledge and give you a shortcut to getting well-informed on this really crucial topic.
And choosing the right account is like picking the right tool. You wouldn't use a hammer to cut wood, like you said.
Definitely not.
So understanding the how and the why behind each one is just key to making smart decisions for your money. We want to demystify these, not overwhelm you, but really give you clarity.
Okay, let's open that toolbox. We'll start with the foundational pieces, the two big players in individual retirement savings, traditional and Roth IRAs.
Classics.
Right, so the traditional IRA, it's your basic individual retirement account, lets you do self-directed savings and totally separate from any workplace plan like a 401k.
Important distinction.
Yeah. There are annual contribution limits, of course.
Yeah.
And the money inside. It grows tax-deferred until you take it out, usually at age 59 and a half.
So you don't pay taxes on the growth each year.
Correct. And the biggest appeal for many, those contributions might be tax-deductible if you're within certain IRS income limits. That means savings on your tax bill today.
Which is always nice.
Always nice. Plus, there's some penalty-free access for specific things like a first home purchase, maybe costs related to birth or adoption, or qualified education expenses.
Some flexibility baked in, and qualifying's pretty easy, right? Just need earned income.
That's basically it, just need earned income.
And that tax deferral is powerful. It means, all your money, potentially every dollar you put in plus the earnings, keeps working for you without the IRS taking an annual bite.
It compounds faster.
Exactly. It's like your investments get a bit of a boost because that growth isn't taxed until way down the road, potentially supercharging your returns over time.
But there's always a trade-off, right?
Always. The trade-off, as you hinted, is that eventually taxes are due. When you hit 73, required minimum distributions, or RMDs, kick in.
You have to start taking money out.
Yep. Even if you don't need it. And that's when that deferred tax bill starts coming due.
Okay, that makes perfect sense. So for someone maybe focused on lowering their current tax bill, the traditional IRA sounds quite attractive.
It certainly can be.
But then there's his cousin, the Roth IRA.
Yeah.
And this is where it gets really interesting for a different kind of tax strategy.
Completely different approach.
With a Roth, you contribute money you've already paid taxes on, after-tax money.
Right. So no immediate tax deduction like the traditional.
No deduction today, but the payoff comes later.
That's the big payoff. Your investment growth and, importantly, your qualified withdrawals in retirement are federally tax-free.
Tax-free, well, assuming you meet the conditions.
Yes. You need to be at least 59 and a half and have had the account open for 5 years. That's the 5-year aging requirement.
Got it.
Think about that, though. Decades of potential compound growth, completely untaxed when you finally need it in retirement. It's huge.
That sounds incredibly powerful.
Yeah.
Are there other benefits?
Oh, yeah. A huge one for the Roth is the flexibility with your contributions, the money you actually put in. You can take that out anytime, for any reason, without taxes or penalties.
Really? The contributions themselves?
Your contributions, yes. Not the earnings, but what you contributed. It gives people a lot of peace of mind. And another big difference. No RMDs during your lifetime.
No. Required minimum distribution, so you never have to take the money out.
Not from a Roth IRA, based on your lifetime. You can let it grow tax-free, potentially forever, or even pass it on.
Okay, so traditional gives you tax benefits now, pay later. Roth makes you pay taxes now, but growth and withdrawals can be tax-free later.
That's the core difference.
So this brings up a really important question for you listening. Are you thinking more about your tax bracket today, or what you expect it to be in retirement?
That's the calculation, isn't it? Pay taxes now when you might be in a lower bracket, or defer and pay later when you might be in a higher one.
And what about people who earn too much? I know there are income limits for direct Roth contributions. Are they just out of luck?
Good question. Not necessarily. There's a strategy called the backdoor Roth IRA.
The backdoor Roth, I've heard of that.
Yeah, it's pretty popular. For those above the income limits, it basically involves making a non-deductible contribution to a traditional IRA and then pretty quickly converting that into a Roth IRA.
So you still end up with money in a Roth.
Exactly. You pay taxes on any growth during that brief conversion period, if any, but it allowed higher earners to get money into a Roth and benefit from that tax-free growth and withdrawal later. Shows how strategic you can be.
Fascinating. Okay, so those are the individual retirement workhorses. But what if you're not just an employee saving for yourself? What if you're running your own business?
Right, the self-employed or small business owner. Different world, different needs.
Your financial toolkit needs entirely different hammers and saws then. Let's talk about the retirement solutions specifically for entrepreneurs and small businesses.
Good plan.
First up, the SEP IRA. That's Simplified Employee Pension Individual Retirement Account.
Quite a mouthful. SEP is easier.
A SEP is much easier. It's designed for self-employed folks and small business owners, mainly for its simplicity, compared to, say, setting up a full 401k.
Less paperwork, General.
Right. Contributions are tax deductible. It's relatively easy to set up and maintain, and it has really high contribution limits. You can contribute a significant percentage of your income.
And that limit can be flexible, right? Based on profits.
Exactly. You can adjust contributions year to year based on how the business is doing. That's a big plus for variable income.
What's the catch or the key thing to know?
Well, a crucial aspect is the balance, as you mentioned earlier about commitment. If you, the owner, contribute for yourself in a given year,
You have to contribute for employees, too.
you have to contribute the same percentage of compensation for all eligible employees. So the flexibility isn't whether you contribute, but if you do, it includes the team.
Got it. And I remember reading it doesn't allow for catch-up contributions for those 50 and older, which some other plans do offer.
That's correct. No catch-up provision in a SEP IRA. Okay, next, the solo 401k, also called a self-employed 401k.
This one sounds specific.
It is. Very specific eligibility. It's for self-employed individuals or small business owners with no employees.
None at all.
Well, a spouse who works in the business can participate, but basically no other employees.
Okay, so really for the solopreneur or a husband-wife team.
Exactly. And the power here is that you can contribute in two ways. As the employee from your compensation.
Like a regular 401k, deferral.
No, often pre-tax. And also as the employer. The business can contribute up to 25% of compensation, subject to overall IRS limits.
So you can potentially sock away a lot more money than in a SEP or traditional IRA.
Potentially, yes. Total contributions can be quite high. They're tax deductible, growth is tax deferred, you usually get a wide range of investment options.
So the main limitations are that no employees rule, and I imagine the money's locked up for retirement.
Correct, on both counts. The no employees rule is strict, and yes, accessing the money typically requires a triggering event, usually hitting age 59 and a half. It's really meant for long-term retirement savings.
Not a short-term cash source.
Definitely not. Okay, one more for the small business crowd. The simple IRA.
Simple. Savings incentive match plan for employees.
You got it. This one's for self-employed folks or small businesses with fewer than 100 employees.
So a bit bigger than the solo 401k user.
Right. Here, employees can choose to defer part of their salary, pre-tax. And the employer has a couple of options. Either match employee contributions up to 3%.
So if an employee puts in 3%, the employer matches it.
Correct. Or the employer can choose to make a non-elective contribution of 2% for all eligible employees, whether they contribute or not.
Interesting choice there for the employer.
Yeah. Employee contributions are pre-tax. The employer contributions are tax-deductible business expenses, and everything goes tax-deferred.
And I assume they're simpler to administer than a full 401k. The name implies it.
Much simpler. Lower admin work, easier setup. That's the main appeal over a traditional 401k for smaller businesses.
Are there downsides? Early withdrawal penalties?
Yes. Standard 10% penalty before 59 and a half. But there's a harsher penalty, 25%, if you withdraw within the first 2 years of participating in the plan.
Ouch. So they really want you to stick with it.
They do. So looking at these three SEP, solo 401k, simple IRA, what does this mean for you if you are running your own show or working for a small company? How do you pick?
Well, it really comes down to your specific business structure and goals. A solo 401k is fantastic if it's just you, maybe your spouse, and you want to maximize contributions.
Highest potential contribution, maybe?
Often, yes. A SEP IRA offers high limits too, but requires contributing for employees if you contribute for yourself, making it good if you have staff and variable profits.
More flexibility year to year, perhaps.
Exactly. And the simple IRA is often a good fit for slightly larger small businesses, maybe up to 100 employees, who want an easier to administer plan than a 401k, but still want to offer them a match or contribution to attract and retain employees.
It really highlights how your choice connects to your business strategy, not just personal savings.
Absolutely. It's about aligning tax strategies, retirement goals, business growth, and employee benefits. Different tools for different stages of the entrepreneurial journey.
Fascinating stuff. Okay, let's shift gears a bit. We've covered general retirement and business retirement. Now let's look at accounts designed for other specific major life goals.
Like health and education.
Exactly. First up, the HSA, or Health Savings Account.
Ah, the HSA. A personal favorite for its unique benefits.
It is unique. It's a tax-advantaged savings account specifically for eligible medical expenses. But here's the key requirement.
You must be enrolled in an HSA-eligible high-deductible health plan, an HDHP.
Right. Can't have one without the other.
And this account is often called the triple tax threat, but in a good way.
Triple tax. Explain that.
Okay, benefit 1. Your contributions are tax-deductible, lowering your current income tax.
Nice.
Benefit 2. The money inside the HSA can be invested, and any growth is tax-free.
Also nice.
Benefit 3. Withdrawals are also tax-free as long as they're used for qualified medical expenses.
Deductible in, grows tax-free out for medical. Wow.
Exactly. No other account offers that trifecta. Plus, incredible flexibility later on. After age 65, it basically acts like a traditional IRA.
Meaning?
Meaning you can take money out for any reason. If it's not for medical expenses, you'll pay income tax on it, just like a traditional IRA withdrawal, but there's no extra penalty.
So it becomes a backup retirement fund if you stay healthy.
Precisely. And it's portable. You own the account. It goes with you if you change jobs or insurance plans, as long as you had an HDHP when you contributed.
That is really compelling. A health account with serious investment power.
But you mentioned that HDHP requirement. That feels like the sticking point for some. High deductible means higher out-of-pocket costs, right?
It does, and that's a valid concern. An HDHP isn't the right fit for everyone's health needs or budget. You need to be prepared to cover those higher initial costs.
So who is it best for?
It's often best for people who are generally healthy, can afford the higher deductible if something happens, or who have a solid emergency fund. The strategy is often to fund the HSA, let it grow, and try to pay current smaller medical bills out of pocket.
Letting the HSA investments compound undisturbed.
Exactly. It raises a key question for listeners. Are you maximizing every single tax advantage opportunity available to you, especially for something as potentially costly down the road as healthcare?
Good point. Okay, next goal-specific account. The 529 plan. The education savings powerhouse.
Right. A flexible, tax-advantaged investment plan designed for future education expenses. And it's broader than people might think.
Not just college anymore.
It can cover college costs, obviously, but also up to $10,000 per year for K-12 tuition. You can also change beneficiaries, which is flexible. And interestingly, under certain new rules, leftover funds might even be transferable to a Roth IRA for the beneficiary.
That Roth rollover provision is a relatively new and powerful addition. Makes people less worried about oversaving.
Definitely. So the main advantages.
The big one is tax-free growth and tax-free withdrawals for qualified education expenses. Contributions themselves are made with after-tax money, typically.
But the growth is where the magic happens.
Exactly. Tax-free growth over potentially 18 years, that can be substantial. And qualified expenses is pretty broad. Tuition, fees, room and board, books, supplies, tech, even up to $10,000 towards student loan repayment now.
$10 in student loans, too. That's useful. Any state benefits.
Yes. Many states offer a state income tax deduction or credit for contributing to their state's 529 plan. So that's an extra layer of savings, potentially.
So what's the strategic play here? Who is this really for?
It's excellent for anyone saving for a child education or even grandchild's nieces, nephews, or even your own future education.
You can save for yourself.
Absolutely. The key benefit is locking in that tax-free growth specifically for education. The main drawback is penalties if you take the money out for non-qualified reasons.
Right. The earnings portion gets taxed plus a 10% penalty.
Correct. It's designed to keep the funds focused on education.
Okay, so we've hit retirement, business, health, education. A lot of specific goals. But what if your goal is less defined? Or maybe shorter term, like saving for a house down payment in 5 years or a new car, or just having maximum flexibility.
Right. Not everything fits neatly into those tax-advantaged boxes.
That's where our next category comes in. Flexible, general investment accounts. Let's start with the most basic one, the standard brokerage account.
The workhorse for general investing. A brokerage account simply lets you buy and sell investments, stocks, bonds, mutual funds, ETFs, you name it.
And its defining feature.
Flexibility. Pure and simple. You can access your money whenever you want without the age restrictions or specific use requirements you see in retirement or health accounts.
No penalties for taking it out early.
None related to the account type itself. There are no contribution limits, no income limits to worry about, and usually a very wide range of investment choices, even things like options if your account is approved for it.
Sounds great. Ultimate flexibility. So, what's the catch? We know there's always a catch. Where are the downsides compared to those tax-advantaged accounts?
The catch is taxes. Plain and simple, there are no tax advantages here.
No tax-deferred growth, no tax deductions.
None of that. Any dividends you receive, any interest earned, any profits you make when you sell an investment for more than you paid, that's a capital gain, it all gets factored into your taxable income each year.
So you pay taxes along the way.
You pay taxes along the way on earnings and gains. You also don't get employer benefits like matching contributions. So it's fantastic for goals outside those specific buckets like retirement or education, or if you've already maxed out your tax-advantaged options.
But you need to be mindful of the tax implications.
Absolutely. And be aware of potential fees, though many brokers now offer commission-free trading for stocks and ETFs.
Okay, makes sense. Now, here's one that's been gaining a lot of traction, kind of blurring the lines. The cash management account.
Ah, yes, the hybrid account.
Right. It combines features you'd normally see in a checking or savings account, like check writing, bill pay, a debit card, with the ability to hold investments like a brokerage account.
Some even automatically sweep your uninvested cash into high-yield options like money market funds or FDIC-insured deposits at partner banks.
So it aims to be an all-in-one place for spending, saving, and investing. The big question everyone asks, is this a bank killer? Is it replacing traditional banks?
It's certainly a compelling alternative for many people. The convenience of having everything in one spot is a major draw.
Fewer accounts to manage.
Exactly. Plus, they often offer really competitive interest rates on your cash balance, sometimes much better than traditional savings accounts. And fees are often low or non-existent.
I've seen some that reimburse all ATM fees worldwide and offer really high FDIC insurance limits.
Right. Some can offer FDIC protection up to, say, $5 million. By spreading your cash across multiple partner banks, that's way beyond the standard $250,000 per depositor per bank.
So high yield, low fees, convenience, extra insurance. Sounds amazing. What are the potential downsides besides the lack of tax advantages?
Well, the lack of tax advantages is key. Any interest earned is taxable income. And they are typically digital first.
Meaning no physical branches?
Usually, yes. So if you need branch services like cashier's checks instantly, or you deposit a lot of physical cash, it might not be as convenient. Online deposits and transfers are easy, but it's a different experience than walking into a bank branch.
So it depends on how you interact with your money.
Precisely. It's perfect for streamlining if you're comfortable with a digital-first approach and want potentially better rates on your cash while having easy access to investing. Really makes you rethink what a bank needs to be for you.
Very interesting. Okay, let's shift one last time to a really fascinating category. Accounts designed to empower the next generation. Getting kids started with investing.
A crucial topic. Starting early makes such a difference.
First up, one specifically for teens, the Fidelity Youthy account.
Right, this is pretty innovative. It's a brokerage account that's actually owned by the teens, specifically for ages 13 to 17.
Owned by the teen. How does that work?
The teen can use it to save, spend, and invest their own money. But, and this is key, it comes with direct parental oversight.
Okay, so parents are involved.
Yes. It's designed for supervised financial education. It's free to open, no fees, no minimums to start, and teens can invest with as little as $1 using fractional shares.
Fractional shares. So they can buy just a small piece of an expensive stock.
Exactly, which is fantastic for learning without needing a lot of money. Parents can view everything, investments, transactions, and get notifications. There's also learning content built in. Sometimes teens can even earn small amounts for completing lessons.
That sounds like a great way to build money skills with guardrails. What are the limitations? No tax advantages, I assume.
Correct. It's a standard brokerage account, so no tax breaks. And the main thing for parents to understand is that while they have oversight, the teen does own the account and makes the decisions. It's not a custodial account where the parent controls everything.
So it's about teaching responsibility.
Very much so. Oh, and the parent needs to have their own Fidelity account to open one for their teen.
Got it. Okay, speaking of custodial accounts, let's talk about UGMA, UTMA brokerage accounts.
The traditional way to gift assets to minors, UGMA is Uniform Gifts to Minors Act, UTMA is Uniform Transfers to Minors Act. UTMA is a bit broader, allowing transfers of assets like real estate, but functionally they're similar for most people using brokerage accounts.
So how do these work?
An adult, the custodian opens and manages an investment account for a minor beneficiary. The adult controls all the investment decisions.
Until when?
Until the minor reaches the age of majority, or termination, as defined by their state. This is usually 18 or 21, sometimes even 25, depending on the state and the setup.
And then what happens?
Then the assets and full control over them automatically transfer to the now adult child. And importantly, there are no restrictions on how they can use that money.
No restrictions at all, so they could buy a sports car instead of paying for college.
Technically, yes. That's a key difference from, say, a 529 plan. The advantage is flexibility, no contribution limits, though large gifts can trigger gift tax considerations.
Like above $18,000 per person in 2024.
Exactly. You can contribute assets like stocks directly, not just cash. The adult maintains control for a long time. But the big caveats are, it's an irrevocable gift. The money legally belongs to the child from day one, even though the custodian manages it.
Must be used for the child's benefit.
Right. There are tax implications. Some earnings might be taxed at the child's lower rate, the kiddie tax, but larger earnings get taxed at the parent's rate. And crucially, these assets can significantly impact college financial aid eligibility because they're considered the child's asset.
More impact than a 529.
Generally, yes. So what's fascinating is that dual nature, providing a gift, maintaining control for a while, but then it becomes fully the child's. Often, a 529 is recommended first for education savings due to better tax treatment and less impact on financial aid.
Good to know.
Yeah.
Okay, finally, maybe the most forward-thinking option for kids. The Roth IRA for kids.
Yes. Leveraging that powerful Roth structure, but for a minor.
How does this work? Is it like the teen account?
It's actually a custodial account, like the UGMA-UTMA, meaning an adult custodian manages it, but it's specifically a Roth IRA opened in the child's name.
So it follows Roth IRA rules.
Yes. Contributions are after tax, the investments grow tax-free, and qualified withdrawals in retirement will be tax-free for the child decades down the line.
Wow, so you're starting that tax-free compounding clock super early.
Incredibly early. It's potentially giving a child a massive head start on retirement savings. The custodian manages the investments until the child reaches the age of majority in their state, then control transfers.
And like an adult Roth, can the contributions be accessed in emergencies?
Yes, the contributions the money put in can be withdrawn by the custodian for the child's benefit or later by the child themselves anytime without taxes or penalties.
Okay, sounds amazing.
Oh.
It's like turbocharging their future retirement. What's the catch? There must be a catch for something this good.
There is one very important catch. The child must have earned income.
Earned income, like from a job.
Exactly. Babysitting, mowing lawns, a summer job at the ice cream shop, acting gigs, whatever. They need legitimate income reported perhaps on a W-2 or as self-employment income.
And the contribution limit.
It's capped at the amount of their earned income for the year or the maximum IRA contribution limit for that year, $7,000 in 2024, whichever is lower.
So if they earn $2,000 mowing lawns, they can only contribute $2,000 to the Roth for kids that year.
Precisely. And while contributions are accessible, the earnings part is still subject to early withdrawal penalties before age 59 and a half, unless certain exceptions apply, just like any Roth.
Got it. So it requires earned income, but if they have it, it's an incredibly powerful way to leverage time and tax-free growth.
It really is. Connecting it to the bigger picture, it's about harnessing the power of compounding and tax advantages from the earliest possible moment.
Wow. Okay, we have truly unpacked a lot today. From those core IRAs to specialized tools for business owners, accounts for big goals like health and education, flexible general accounts, and even ways to kickstart investing for kids.
It's a wide range of tools.
It really reinforces that idea we started with. Investment accounts are crucial, purpose-built tools for your financial journey.
Absolutely. And the key takeaway really is that there's no single best account. It's not one size fits all.
Not at all.
The right account or mix of accounts depends entirely on your unique financial goals, your tolerance for risk, your tax situation right now and what you expect later, your business structure if you have one, your age, all of it.
So wrapping this up, what does all this mean for you, the listener, as you navigate your own path?
Well, maybe the question to leave you with is this. Given this diverse range of investment tools, each with its own specific job description, its own pros and cons, how might understanding these differences empower you?
Empower you to do what?
To maybe reevaluate your own financial goals, look critically at the tools you're currently using, and ask yourself, Are these the best tools for the jobs I need done? Or are there other tools in this box that could help me reach my goals more effectively, or maybe even achieve goals I hadn't considered before?
That's a powerful question, a prompt to audit your own financial toolbox. We hope this deep dive helps you consider which accounts might be the perfect fit for your next step, or maybe just helps you use the ones you already have even better.